Hi, everyone. Steve Nissen here, and I want to congratulate you for having the insight to join this special presentation by my good friend Larry McMillan. He and I go back a long, long way, so I'm really excited to have him here to show you some really great techniques and strategies that you can apply right away. What I am to candles, Larry is to options. He is a true option expert, author of best-selling books on the topic, and lots of real world experience. In fact, there's a wonderful Japanese proverb that says a book gives knowledge, but it is experience that gives understanding. And Larry has both those. He has, like I said, a best-selling book, and he has really great experience. So without any hesitation, I want to turn this over to Larry, and thanks for doing this for our group, Larry.
All right, Steve. Thanks. All right, let's get started. It's a pretty interesting time in the market here to be discussing option predicting indicators. Just a little bit about our firm. We started out as a derivatives research firm originally, meaning we were selling data, publishing research, and newsletters. In the last 10 years or so, we've moved into money management. So we are both a CTA, which is Commodity Trading Advisor, and RIA, Registered Investment Advisor, for specifically option-oriented accounts, individual accounts. And then we also do a certain amount of option education, including webinars like this and mentoring and other things. So let's get started. There's four main indicators that I look at when we're discussing the market. The first is obviously the chart of the S&P 500, and price is the most important indicator, so we need to keep track of the chart. And we have an option-oriented way of looking at that. Then we also look at put-call ratios, market breadth. Again, there's an option twist to that. And then volatility, primarily VIX, but some other things. And then at the end, we'll talk a little bit about some seasonal patterns that are existing right now as well. So as we're going through this, we don't really have any oversold conditions right now, but I have an old rule that oversold does not mean buy, and conversely, overbought does not mean sell. We do have some overbought conditions, and we've had them for a while. But the market continues to go higher anyway. So you really need to wait for confirmed signals. You can't just act on overbought or oversold conditions, or you'll be on the wrong side of the market. Perhaps when it's accelerating most rapidly, like last December of 2018, the market got oversold at the beginning of the month, and by Christmas, it had gone down a lot, was still oversold, but actually had not turned yet. So here's the current chart of S&P. There's a couple of things on here that are, somewhat important. It doesn't have today's line on there. Oops, let me get the color here right for this. Hold on a second. So today we moved up to new highs. High was 31.76. So today's line is up here about like that. Breaking out to new highs. But the interesting thing about the chart is there's two support areas. This one right here at 30.75, 30.70, 30.65.70 is where we had pulled back to both in early November and then last week in early December. The market rallied right off of there. So that's really strong support. And then below that, the two previous highs, all-time highs last July and September, we're at 30.25, 30.30. When we broke through there to new highs in October, we had a little test of that area and then took off to the upside. So that's another support area. You can see this is a pretty bullish chart. I mean, your 200-day moving average is moving higher. Your 20-day moving average is moving higher, and just about any other kind of moving average you want to look at is trending higher as well. So this is a pretty simple interpretation here. One other thing is there's a gap. At the time, I considered it important. It's becoming less important as we move away from there. But there's a gap from 29.50 to 29.60, which has not been filled, and that's quite bullish. To fill that gap now is, a 200-point decline, so that's probably less meaningful than it was when it first happened. But just to summarize, we're a pattern of higher highs and higher lows, so we're in an uptrend. As I said, there's support at 30.65.70, and then below that, 30, 25, 30. There really isn't resistance here at all-time highs. Obviously, there are places where people would sell, but there's no specific chart resistance. So the trend lines are positive, and overall this is bullish and will remain that way. Even if we were to pull back all the way to 30.70 again, where we bounced off there a couple of weeks ago, that'd probably be a little disappointing, but again, it's not that big of a percentage drop from here. And if we pulled back there, I would expect support to hold. Now, another thing that we look at on the S&P charts is what I call modified Bollinger Bands. And Bollinger Bands, when John Bollinger invented them, you needed to define volatility. And so he used, as the definition of volatility, he used the standard deviation of daily closing prices. Well, that's good. Sounds to me like that's a reasonable definition of volatility, but it's not what the math guys use. So for example, we're pretty heavily dependent on Black-Scholes in the option business. So they have a definition of volatility that's slightly different. In fact, their definition is the standard deviation of daily percentage price changes. And so it gives you a slightly different number, but all of our work depends on lining up with Black-Scholes in terms of implied volatility, deltas, any other thing to do with options. And so in this regard, we're sticking with the Black-Scholes definition of volatility as well. So it gives you slightly different bands. Again, still around the 20-day moving average, just as John Bollinger did in the original. The way we define it is we draw the plus or minus 4 standard deviation band. And when the S&P moves outside of that band, a signal will set up. And in the last year, and I'm going to show you a chart in a second, there have been some pretty good gains on this. Occasionally, there's a stopped out signal where you'll go, let's say, above the +4 sigma band, you move back inside, and you move back outside it again. That stops out that signal. Most recently, it did issue a sell signal. It's one of the few sell signals we have right now. On this chart, a red letter indicates a successful signal. A blue letter indicates an unsuccessful signal, and then of course the last one here is green because I don't know yet which way that's going to turn out. But this upper line right here, that's the plus 4 standard deviation line, and the one just inside it is the +3 standard deviation line. So for example, you can see, let's just take this one here. We moved outside the +4 sigma and then later inside the +3 sigma, and that gave us a sell signal. On the downside here, we moved below the -4 sigma and then inside the -3 sigma, and that was a buy signal. So most recently, we did have the sell signal that occurred right here, and it was quickly stopped out when it moved back above the +4 standard deviation line. Then we had another sell signal right there, and it's possible that this was going to be stopped out too. It was not stopped out today. But you can see that there have been occasions where we've had a couple of stopped out signals and the market moved higher. But by and large, this has been a pretty good indicator, especially in in times when the market gets really extreme in a very fast manner, when it collapses like this on the downside. And of course, then there was the big signal last around Christmas. So when we get these signals, those or others, as I'm going to show you some more in a minute, we're buying options. And in general, when we're trading the broad market, we're buying spider options, SPY options. So which ones do we buy? Well, we typically gear the option that we're going to buy off the trading system that we're using to get into it. But in general, it depends on the delta of the option. It's quite important. So the delta of the option is just how fast the option moves with respect to the stock price. And the delta of a call option ranges between 0 and 1. Now, let's say a lot of options are expiring tomorrow. So let's say, right now, SPY is at 317. And maybe if you own a December 13th, that's tomorrow, expiration, 340 call, that didn't go up at all today, even though S&P was higher. So that option has a delta of 0 because it's going to expire tomorrow. On the other hand, if you own an in-the-money call, let's say December 13th 300 call, that's so deeply in the money that it's moving point for point with the stock, so it would have a delta of 1. And obviously, the higher the delta, the more the option behaves like stock, or in this case, the underlying ETF. The lower the delta, though, the more speculative your purchase is. And so, a lot of times I'll find people say that they're pretty good at stock picking, or they follow some guys who are good at stock picking. And when they try to convert it to option trading, it doesn't work. They lose money. Typically, the reason is that they're buying something too far out of the money rather than something that acts like the stock, which they're good at picking. Now, a broader definition of which option you want to be in falls with this statement. Whatever you have a trading system, you have something that's getting you into the trade, and that trading system has a time horizon. It could be day trade, it could be a few weeks, it could be months. But the shorter the term of your trading system, the time horizon of your trading system, the higher the delta should be of the option that you buy. So in these trades that we're talking about here in Spider and some I'll show you later, these are pretty short-term trades. We're going to be in these for maybe just a few weeks, maybe not even that long. So we're looking at something with a delta of 0.7 or more. So we're buying, typically what we buy is we buy a SPY option that's at least one strike in the money, if not even a little farther. So again, I'm just repeating there that if you had a successful stock trading system, you can convert it to an option trading system following that rule at the top of the page here. I don't want to spend too much time on this, so let's move on to put-call ratios. Put-call ratios were invented as a contrary indicator by Marty Zweig back in the 1950s when he used to get the put and call volume out of the ads that ran in Barron's on the weekend. Each put and call dealer, there were about 6 or 8 of them at the time, would place an ad and show how many contracts they traded the previous week. And, in a whole week, they might trade, 1,000 contracts or 1,500 contracts. Now we trade that much in the first few seconds. But Marty did notice that if everybody was buying calls, it was about time for the market to go down. And if everybody was buying puts, the opposite would happen. So we use equity-only put-call ratios. In other words, all stock options that trade, equity stock, all stock options that trade, that's millions of contracts, at least a couple million a day. And so that's what we use as a predictor for the broad market. And I'll show you a more detail on that in a minute. But as the contrary theory goes, if everybody's in there buying puts, then they've probably exhausted themselves and it's time for the market to go higher. So it's a contrary indicator in that regard. Conversely, if everybody's in there buying calls, we should be thinking about doing something bearish. So simplistically, let's just say at IBM at the end of the day, we sum up the volume of all the puts that traded in IBM. Separately, we sum all the calls and we divide the two, and that's the put-call ratio. Which is the way it was originally designed. So since puts are in the numerator of this fraction, heavy put buying makes the ratio go higher. But typically, we would get heavy put buying when the stock is falling, so they would be moving in opposite directions. In a similar manner, since calls are in the denominator of the fraction, heavy call buying will make the ratio go down. So when call buying is increasing, the ratio will drop. But obviously, call buying usually happens in a rising market and the stock goes up. So again, they're moving in opposite directions. We keep a moving average 21 days just in case there's anything to Fibonacci. I'm not totally convinced of that, but we will. You do need some sort of moving average to smooth out the numbers because they're a little bit volatile. So typically, in theory, it would look something like this. As the stock price, let's say the stock price is falling. So as the stock price is falling and falling and falling, more and more people are buying puts. And during the trend, the public is right. They're making money on the put purchases. But eventually, as we get up here and the put buying exhausts itself at its peak or a local maximum on the put call ratio, that's a buy signal for the stock. So when the put call ratio peaks, makes a local maximum, that's a buy signal for the stock. From there, the stock should go higher. And we eventually get over to this state where the call buyers are forcing the put call ratio lower, and eventually the call buyers run out of momentum, and we get a local minimum on the put call ratio chart, and that's a sell signal for the stock. So in theory, that's how they should look. We publish about 450 put call ratio charts on our website every day, and something that we call the strategy zone. This is our website. In something we call the strategy zone. And so if you're looking at a put call ratio chart, we show the stock price with it. You should see that inverse symmetry. If you don't, then there's probably something else going on, perhaps a takeover or arbitrage or other things. We're trying here to measure speculation, not hedging activity. So this is not a current chart, but on the top is the S&P 500, and on the bottom is the equity-only put call ratio. So you can see that most of the time this inverse symmetry does exist, and that's why we use the equity-only put call ratio as a predictor of the stock market. So here's the current chart, and you can see that remember again, local maximums are buy signals. So we had a great one last January. This one here in late November was short-lived and kind of premature. And then as we've gone along this, we came down to a local minimum here in May, and the market did sell off some, and then we had another buy signal on the local maximum, and et cetera, et cetera. We had a good buy signal there mid-October, and now the put call ratio has fallen so far here. By the way, this number on the left, 60, means that 60 puts are trading for every 100 calls. That's a pretty low number in today's environment. In fact, that's as low as it's been since February of 2018. So we got very, very overbought, and now a local minimum has formed on the chart, and this has rolled over, therefore, to a sell signal. Again, not much has happened in regards for the market going down, but we certainly got overbought in terms of the put call ratios. Now, as computers came into action, we were able to calculate another kind of put call ratio called the dollar weighted put call ratio. In this case, we're trying to measure the dollars being spent on bearish opinion versus the dollars being spent on bullish opinion rather than just the volume. So there's a couple of ways you can do this, but what we do at the end of the day, we take the options closing price, multiply it by the volume that traded that day. Now you could do every tick, every trade that takes place. That's expensive data. A lot of computer firepower goes into calculating that. We tried that for a while, and it really wasn't giving us any better predictions than just using it with closing values. So that's what we do. So we make that calculation for every option that traded. And again, let's say it's IBM. At the end of the day, we sum those calculations up for all the puts. Separately, we sum them up for all the calls and divide the two, and that's the put call. That's the weighted put call ratio. So it works just like the regular put call ratio. Local maximums on the ratio chart are buy signals for the stock market, etc. So here's the current chart, and what you do here is you get more extreme. So for example, last December, January, when we rose to that very oversold level, we got up to about 190, which means that $190 were being spent on puts for every $100 being spent on calls, which is a lot in terms of stock options. Typically, stock options on a regular basis, more money is being spent on calls or trading calls than trading puts. So again, local maximums, are buy signals. So we had, buy signal at the beginning of June, and then in September, and then again in October. And now here, we've rolled over to a local minimum, and again, that's a sell signal. And again, this ratio is the lowest you can see on this chart, and it goes all the way back to February of 2018. So, if you recall, February 2018, it was right before the market broke down badly. And, the market was very overbought at that time. So it's very overbought again right now, certainly in terms of option speculators. But these ratios, just to sum this up, these ratios have done a pretty good job of catching the major market swings, I say here, in 2018-19, but really all the way back as far as I've been using them. They've now rolled over to sell signals from very overbought levels, very low levels on their charts. And typically when you get the signal from an extreme like that, it's a better signal. So the status of the put-call ratios is definitely bearish. How do we trade these? Well, here in these, we can be in for a few months. So I trade this with a slightly smaller delta. Here I'll use an at-the-money option rather than an in-the-money option. I'm trying to balance the price of the call that I'm buying or put versus how much time there is remaining. So our risk versus our reward. So an at-the-money call typically has a delta just a little bit bigger than a half. And so if the stock moves up or the underlying moves up, we'll be participating, just not as much as we would have if we'd have bought a higher delta call. But as it moves up, the delta increases as well. So that kind of catches us up. On the other hand, if things go bad here, we're only risking the time value, and we haven't bought an in-the-money call. We're not risking any really intrinsic value. So what about spreads? If you watch TV and you see the option shows, they almost always spread every single recommendation, which is, I think, absurd. I know a lot of professional option traders, and they don't use vertical spreads all that often. So typically, we're in the business here trying to ride our winners and cut our losers. By buying an option and knowing what you're risking, you automatically cut your losses. Yes, it's 100%, but you should only be investing maybe 2 to 3% of your portfolio in any one option purchase. Meanwhile, if it takes off in your favor, you want to make some large money. So if you've created a spread out of that, sold a call against the call that you bought, you're going to cut off your profit potential. And I'm definitely not a fan of doing that, except when the options are expensive. So that means the implied volatility is high. If we look back at a historical basis. So again, we publish implied volatility charts on our website in the strategy zone. So a quick glance, we also have tables of volatility. A quick glance will tell you if the options are expensive at the current time or not. So one very typical way that options get quickly expensive is when the market breaks to the downside, when volatility explodes to the upside, VIX takes off when the market goes down. In that case, then bear put spreads do have some credibility because you're selling a very expensive out of the money option against probably a pretty expensive at the money option that you're buying. So there is a time to use the spread, but it's only when options are expensive. So before we leave this subject, I want to look at some individual put-call ratio charts, and we calculate these on stocks. As I said, we publish about 450 stocks and futures contracts every day. Here, we're a little more particular. I'm only going to be interested in taking a signal if the put-call ratio is very, very high or very, very low. Any in between local maximums and local minimums are not a signal for stocks. And so what do I mean by very high? Well, it would be in the 95th percentile of all previous put-call ratios over the previous 600 days. So for example, this one right here is a local maximum. And if we look back 600 days, the put-call ratio had not been that high. So that is a valid buy signal. Modestly profitable. We kind of moved up a little bit higher. But then this is Baidu. Once the trade wars, tariffs and what have you got rolling, people were buying massive amounts of puts on these and forced the put-call ratio up to this level, which now is the new 100th percentile. And it rolled over from there, and that really wasn't much of anything, but it went higher and then even higher again. So these were both buy signals. We acted on these in our newsletter. We eventually got a little bit of a rise in the stock, and now the put-call ratio has come all the way down here and made a local minimum. Now that's not technically a sell signal because it's not in the 10th percentile of all previous readings. You can see these were lower here, and there were a lot of lower ones going in the past. So that's not a sell signal by that regard, but it is the end of that buy signal. So when that starts to happen, we begin to use a trailing stop, and we set the trailing stop right here at support on Baidu. And so if it breaks down from there, we'll be out. Otherwise, if it manages to go higher, then fine, we're still in the trade. So we combine a little technical analysis along with the put call ratio analysis, the stock was up like 4 points today. Here's another one, JP Morgan. This has worked out pretty well. You can see here that this first one was a buy signal, local maximum coming, you can't see back 600 days there, but that was the highest it had been in 600 days. It was a little bit early on the buy, but then it got rolling. Then it came up and made another buy signal from just a slightly higher level, but that was also an extreme percentile. That one, I give it a B, a blue signal for not a winner. I mean, the market maybe did go up a little, but not too much. And then we got this most recent one in September. And you can see the stock responded pretty well right away, but then started to back off. Does that take us out? Well, no, because my rule of thumb on these is as long as the put-call ratio is still declining, it's still on a buy signal, I'm still in the trade. So we were staying in the trade at this point. It got its act back together, took off to the upside, and then we got one of these local minimums. Again, that would be a sell signal in terms of just the fact that it's a local minimum, but it's not in the 10th percentile or lower, so it's not a real sell signal. But it does, again, tell us to start using a trailing stop. Well, the stock has been so strong that we haven't been stopped yet. You were still using the trailing stop here. We're still in this trade. So again, you can combine the extremes to get into the trade and then manage the position as it goes along. Here's a recent one, Intel. Just gave a sell signal here, and you can see that what I like to see is some previous sell signals from similar levels worked pretty well. This one worked decently. There was a buy signal in that it worked pretty good too, but we're dealing with this sell signal right here. So we're in this trade, and the stock did rally back a little today. So you're pretty much almost where we got in the trade. So this would be an interesting one. And as I said, we're in this trade as long as this sell signal exists. So as long as this put-call ratio continues to move higher, we'll stay in this trade. This is the retail ETF XRT, and it gave a sell signal in November. Here you can see the sell signal, but there had been a couple of attempts to break the 43 level, so we put a condition on this one. We're not taking the position until or unless it falls below 43. It hasn't done that yet. So even though we had this sell signal and it's still in existence, and the put-call ratio is still moving higher, we don't actually have a position yet. We're waiting for confirmation from the chart, a breakdown below 43 in this case. Canopy Growth is, of course, a very interesting one. People trying to pay a lot of attention to the marijuana stocks. You can see that there was a nice sell signal back there, buy signal here, sell signal here, and then we kind of worked our way higher. Eventually got another buy signal right here, which was very short-lived, probably too short-lived to count that as much of a winner, so I kind of made that one purple. And then we got another buy signal at even a higher level here, and that one was pretty much a dead clunker. And now we've had another buy signal. So, but what we're doing here is we're waiting for it to break out over twice it's rallied up here to like 22 and change and hasn't been able to get through. So if it can get through to there, 22 and change, and we're still on the put-call ratio buy signal, then we'll take advantage of it. So the stock is about 21, was actually 21.13 right now. So we're not that close to the buy signal here. Cigna is another one that just came out, just came as a sell signal we had in our newsletter last week, and we put a condition on it. If it broke down below this level right here, we would take the trade. Well, it did, and so we're now long puts on Cigna. That's a fresh trade, so if you want to join in with us, that would be one to look at. We also look at put-call ratios in futures. So a lot of futures have an ETF that accompanies them. So like, for example, gold has GLD and oil has USO, and even corn has CORN, all ETFs. Live cattle does not, though. And so we got a live cattle sell signal back here. The chart up here, by the way, is the continuous chart of live cattle. And that sell signal was pretty good. A buy signal there was sort of a sideways clunker, but this buy signal here was pretty good. And now we've gotten all the way down to the other extreme. We've got a sell signal. But there's, again, support on this chart right in here, just below 124 on the front month Feb live cattle contract. And so we're waiting for to break 124 before we actually buy puts. So far, it hasn't done that. So as I said, we make a lot of recommendations in these in our newsletters. I'll talk more about our newsletters later, but this is an area that we've been pretty successful in, especially in the last few years when we went to taking only the extreme signals from the stock and futures put-call ratio signals. The third thing we look at as far as predicting the market is breadth. So breadth is just simply the amount of advancing stocks minus the amount of declining stocks every day. So you can keep a cumulative total if you want. That's done quite often, and right now, by the way, the cumulative totals are making new all-time highs along with the market. So we use them as a contrary indicator, a negative divergence kind of indicator, and there is no negative divergence from the cumulative put-call ratios, cumulative breadth figures right now. But another thing we can do with them is we can keep an oscillator, and our oscillator is defined as this. The oscillator today is 90% of yesterday's oscillator value plus 10% of the difference between advances and declines today. So we can keep that with New York Stock Exchange data. And if you want to keep that at home, I can give you yesterday's value, which you need to start this calculation. If you want to just shoot me an email or something, if you like to do it yourself. But we also made another change. The New York Stock Exchange data includes things that are not stocks. There's a lot of interest rate related things. There's cumulative preferreds, etc. So we were looking around for a set of data that was just stocks, and the New York Stock Exchange does publish something called the operating companies only data, but we say, well, we had a great set of stocks of our own, all stocks that trade options. So we make a calculation of breadth every day on all stocks that trade options, and that's what we call our stocks only cumulative breadth as well as the oscillator. So here's a chart of the stocks only oscillator going back to 2013. And by the definition that we use, it's oversold when it gets below minus 400, and it's overbought when it gets above 200. But remember what I said at the beginning, oversold does not mean buy, and overbought does not mean sell. So for example, last December, it got to the most oversold reading in history. But we didn't really buy until right here when it stopped being oversold, which I believe was something like January 8th or something like that. So we had a great run to the upside, markets roaring away, and now it got extremely overbought. In fact, this area right in here is the biggest red area on this whole chart, and the market got massively overbought. And it wasn't just this indicator, many indicators that measured, specifically ones that measured volume and breadth, were extremely overbought, which led to this condition down here that some people say that when you get that overbought, it's a long-term buy signal for the market. I'm not a long-term trader, so I don't really know, but I'm just mentioning that there. Eventually, though, that did generate a sell signal too. Over in here was kind of a little brief one. And we've gone back and forth, and now right today, we're above 200. I'm not exactly sure how far above because I didn't calculate today's numbers, but we're roughly around 300 or a little bit higher. What I like to see when the market is making new all-time highs is for this thing to get really overbought like this. That would be great because that indicates that there's a lot of participation in the market. That hasn't really been happening so much in recent months. So breadth is positive, but not as strong as maybe you'd really like to see it. But in any case, it's on in an overbought situation, which is a buy signal, and we'd like to see it get even more overbought. I mean, breadth was positive today, but on the New York Stock Exchange, it was only positive by about 700 issues, which, considering the market was monstrously up all day, that's really not that great. Anyways, to summarize here, the breadth oscillators recently canceled out sell signals and moved into overbought territory. So I'm just going to say we're about a plus 300, and that's a buy signal for now. As I said, we'd like to see it get overbought, but that hasn't happened. So we're a little bit cautious there. And the cumulative advanced decline lines have made new all-time highs, so that's not a problem for this market right now. So overall, breadth is positive, but not roaringly so. The fourth indicator we look at is volatility, and there's a couple of things going on with volatility that are important. First is the trend. So typically, VIX tends to trend the opposite to the stock market, and in particular, we have ways of measuring the trend, but it's very important to discern the trend of VIX when one does exist. Secondly, if VIX spikes up and spikes back down again, that's a buy signal, short-term buy signal for the market. So these are two things that we specifically look at when we're talking about volatility, using a VIX as a predictor of the stock market. So what can happen, VIX can get very low and which would be overbought, VIX down like 10, 11, 12, whatever. But it's really, the market can continue to go up when that happens. Again, overbought does not mean sell. So when that happens, you don't just sell automatically because VIX is low. You wait for it to start to rise. So I'll give you some specifics, but here's the current chart of VIX going back about a year. And the buys, the little B's on here, are spike peak buy signals. So we have a well-defined system for this. I'm not going to go over the system here, but you can see here VIX spiked up and back down and gives a buy signal. So the red letters are successful buy signals. The blue ones are not. This one you might wonder, well, why wasn't that in May? But what happened is that signal came in early May and the market went down after that. So it went very hard for someone to make a profit on buying that option there, or buying an option on SPY early in May. Eventually it turned around, of course. So these systems last for 22 days. And if we're in it for 22 days and then the system sort of expires, we get out. Sometimes there's multiple signals within the same 22-day period. So for example, there I've marked them with these smaller B's. We only trade the first signal, not the other ones, not the little ones there, but those were both very successful, and the one that occurred at the beginning of October was good. Now we just had another spike peak buy signal here on December 4th. It came from a pretty low level here. This is VIX spiked up to 1799 and then right back down again the next day. That is a buy signal by our system. You might say, wow, it's so low on the chart. I mean, that's lower than any of the other ones. Why even bother taking it? Well, it turns out that, you can go back in history, whether it's low or high, it pretty much is a successful system, and I don't want to try to pick and choose. That's how you get in trouble. You end up missing good signals that you talk yourself out of. You're better off viewing these things dispassionately and just taking all the trades and keeping your risks small by managing your option position and not necessarily trying to second guess the system itself. Obviously, the market's gone up quite a bit since December 4th, so that's a good signal. Now, so that's the short-term thing. What about the longer term? Well, this is the 200-day moving average of VIX right there. And then, I'm sorry, that's the 200-day moving average. This more wiggly one is the 20-day. So we have another rule of thumb. When the 20-day crosses over or under the 200-day, that has a chance to determine the trend, but we need to see where VIX itself is at the time. So for example, right here, it crossed over and VIX was below. So the 20-day crossed below the 200-day and VIX was below. That's an intermediate term buy signal for the stock market. Even though a couple of times it crossed back above, VIX did not stay above long enough for it to be meaningful. So for example, right in here, it looked like we were going to get an intermediate term sell signal, but it didn't happen. And now the last time we had a crossover was right here again in late October. The 20-day cross below the 200-day and VIX is below. So that's the situation we're in. Twice this week, VIX actually managed to close above the 200-day. It's not there now. It's fallen back to below 14 again. Today it finished at 1394. This chart was through yesterday, so today's bar on the chart is something like that. But the 200-day is up here around 15, and the 20-day is here around 1370 or so. So it wouldn't be an intermediate term sell signal even if VIX were to stay above there. Now, obviously, I'm a little concerned that VIX might have been too low, and so we were setting just the 16 level as a level above which, if VIX closes above 16, we would begin to take some negative positions. VIX has not closed above 16 since back there in early October, and that was on its way down at that time. So just to summarize here, we have the short-term buy signal in VIX, and we're saying that the intermediate term, the trend of VIX, is not trending higher, so that's bullish for the stock market as long as VIX is below 16. If the 20-day went above the 200-day, that would be a cause for large concern, and we'd have to get aggressively bearish at that point, but it doesn't seem like that's happening anytime soon. So overall, the VIX chart is bullish for the stock market. Now, there's another thing that we look at in terms of volatility, and this brings in the volatility futures, and we call it the construct of volatility futures. But we look at two things. We look at the premium, in other words, whether the futures are trading above or below the price of VIX. And we look at the term structure. The term structure is just like the front month VIX future is December, and then let's say January is higher, and February is higher, and March is higher. If the term structure is sloping upwards like that, that's bullish for stocks. So it's bullish when the futures are at a premium. In other words, the futures are trading above the price of VIX, and the term structure is sloping upwards like this. That constitutes a bullish scenario. It's bearish when the opposite occurs, and particularly if the term structure inverts. That's a time that you should quickly act and take some defensive action, but that hasn't been the case for a while now. So here's the pricing as of last night. It's not too much different tonight. VIX closed at 14.99 on the 11th, and here's the price of the future. So the front month future, which expires next week on Tuesday, well, Tuesday's the last trading day, is actually closed below VIX. So the premium 14.78 minus the price of VIX 14.99 is minus 0.21. So that's not bullish. But the rest of them, you can see that each one is priced higher than the other. The term structure is sloping upwards, especially steeply here in the front end, and it kind of flattens out after that. But here's the premium. All the rest of them are trading a premium to VIX. So all in all, that's bullish. The front month one is probably still a little bit of a hangover from the Fed reaction, or from a reaction to the Fed minutes yesterday. Let's just see where, today that closed still at a small discount of 19 cents. Now, if you don't have the access to the futures prices, although it's very easy to get them, the CFE, which is the CBOE Futures Exchange, has a website. And on the front page of that website is delayed quotes on all the futures that they trade. So very easy to check the price of the futures. But if you don't want to do that, the CBOE does publish some volatility indices of their own. And we all know they publish VIX, which is a 30-day volatility measure, but they also publish VIX 9-day, which is a 9-day volatility measure, a short-term thing, a 3-month, a 6-month, and a 1 year. So you can look at how these line up with one another, and again, looking for the term structure to slope upwards. But you can see it does slope upwards here on these four, but the very short-term one is actually last night was higher than the price of VIX, and it has been all week and still is today. I'm sorry, yes, it is today. So tonight, even though the market was up today, the short-term volatility is 14.67 and VIX is 13.94. This is the December 12th closing prices. And so you can see it's still inverted. That's a little bit disconcerting. I wouldn't go overboard and start going short the market on that. So rather than say that this is a completely bullish scenario, I'm going to say it's mostly bullish. But that front, there's obviously some traders who are feeling there's some short-term risk in the market right now and have forced the short-term volatility estimate up. what, specifically what's causing that is typically these are all based on the price of SPX options that trade on the CBOE. And typically if people are buying puts with that short-term expiration, they're expecting they're going to force this number up, and they're expecting something to happen in the short term. So, before the Fed meeting yesterday, it was understandable. Now that the Fed meeting is out of the way, it's a little bit less understandable, especially since there was positive news on the trade front today. But, with technical indicators, I try not to get too deep into why they're doing what they're doing. We just observe what they're doing and act on them as signals. But in any case, the VIX futures are mostly at a premium, just that front month is not, but the term structure slopes upwards. The CBOE indices are mostly upwards except for that first one. This is a bit of a problem here. The VIX and the VIX 9-day are inverted, but overall, this is mostly bullish. So where do we stand? Let's just summarize these things here. The S&P chart, we saw that's bullish as long as it stays above support at 3065. There is a modified Bollinger Band sell signal. Put call ratios, they're bearish. They turned upwards on, that's a negative sign. But as long as the SPX chart is bullish, it's very difficult to short the market. Breadth oscillators that are sort of mixed. We just went to slightly bullish there. Both of them have now moved above the plus 200 level, so they're slightly bullish. VIX is still bullish because it's trendless, it's staying low and not trending higher. The term structure, as we just saw, is mostly bullish. So if we put that all together, it's bullish, but we're remaining alert. I mean, by that, like if you're long calls and they get deeply in the money, roll them up to higher strikes, take a credit out of the position, make sure your trailing stops get moved up as if the underlying moves up, and just generally don't be complacent, don't fall in love with the long side, and act on sell signals if they occur. So we typically might have some calls based on long signals and also some puts based on sell signals even at the same time. It's when you get an extreme situation like you had last Christmas, then everything rolled over to a buy signal pretty much at the same time. But in a normal market like the one we're having now, you're going to have some on both sides, and each one of these has a system that we use, and we adhere to our system rules, and we try not to just throw a lot of random thoughts into there. I had mentioned negative divergence. I had mentioned that cumulative breadth was not negatively diverging, so that's a good thing for the market. New highs are staying above new lows, so again, that can be a divergent signal, but it's not right now. But the one that is, and this has been in place for quite a while, is that the Russell 2000 has been underperforming the broad market. This goes back to the middle of 2018. And when that chart is declining, that means that the Russell is underperforming the S&P. Now, just here in the last few days, it has seemingly broken this trend line. But again, it's certainly not turned around, and it's been a long ways happening. So I'm still calling this a negative divergence. Now, a negative divergence doesn't mean you go out and short the market, but it does mean that you're paying attention and you don't ignore sell signals. So that's all we're using this for at the current time. I mentioned some seasonal bullish patterns or seasonal patterns. There's a kind of three things that go together. There are three different systems. We've combined them into one. One is that there's typically a rally right after Thanksgiving. Even last year in 2018, S&P was up 140 points the week after Thanksgiving and then collapsed badly. So most people have forgotten that. But there was that rally. And if you were long calls, that was plenty of room to roll up and roll your calls up to a higher strike. Secondly, there's the January effect, which now takes place in December, where small caps outperform big caps having to do with tax loss, selling, etc. And then finally, there's the Santa Claus rally. And I know on TV they use that term for everything, but there's a very specific system based on that, designed by Yale Hirsch and over at Stock Traders Almanac. And it involves 7 trading days, the last 5 days of one year and the first 2 of the next year. And during that time, the market typically rallies. If it doesn't, that's negative. But typically, put all three of these things together, and we've shown that if you buy Russell 2000 to take advantage of the small caps doing better in December, you can buy them right before the last trading day before Thanksgiving and hold them into the new year. Typically, that's a winning trade. Obviously, it wasn't last year, but this year we are long the Russell IWM as the Russell 2000 ETF. We're long the Jan 3rd calls expiring January 3rd. And we bought them right before Thanksgiving. Here's the track record for that system. In the last 27 years, it's been a winner 21 times, and on typically the Russell will rally 2.8% over that period of time. So, that's decent. I mean, it's not unbelievably good, but still 2.8% is, in a period of just over a month is not bad. There's another season. We follow a lot of seasonal patterns. The next one after that comes up in late January, which also has a pretty good track record. It's a very short-term 4-day system. It's won 27 of the last 34 years, and typically the market will go up 1% in those 4 days. So again, enough room to make a profit. So before we conclude, I want to offer this is only good for listeners of this webinar, a special on our daily volume alerts. Daily volume alerts not only trades all of these systems that we talked about, but we also look for takeovers. So this month we actually hit 2 takeovers on the same day. We were long Tiffany calls, which we bought on November 25th, and I'm sorry, we bought the calls on October 30th. On November 25th, the company received a $135 bid, which was an increase from a previous bid. And then also we were long Medicines Company calls. We had bought those in November 20th, and pretty shortly thereafter, the company received a large takeover increased bump from Novartis. So we have those recommendations in with all of the other recommendations, including the seasonal trading, the broad market put-call ratio signals, etc. This year we're up 11,000 on all of our trades, and we're typically looking at this as a $50,000 trading account where you're only putting about $1,500 in each trade. Our SPY recommendations are up about 7,000. So we're offering here a 30% discount if you go to this website, optionsstrategist.com/DVA. That will automatically apply a coupon of 30% discount. If for some reason it doesn't, the coupon itself is NISON, NISON, and this offer is only good for a week. So if you're interested, I encourage you to take a look at this. Also, we've been doing some other things recently. We're having some Saturday morning seminars. We're going to send you the PDF of this seminar as well as a recording. And in there, you'll be getting some more information on these things. But we are doing once a month, like a Saturday morning, more intense, in-depth webinar on a subject, and then also covering market conditions, having a question and answer session, etc. And also we have a YouTube channel now, so if you want just a quick market comment, we record market comment, and this particular one here was lasting 3 minutes and 40 seconds every Monday morning. So that's it. Take advantage of the DVA offer if you are interested, and we will be sending out the questions to everyone. So let me just see, did anybody write any questions in here? No. Oh, wait, maybe they did. Hold on. I'm always having trouble. Okay, how do you track put call ratio on the 21 DMA? I'm not exactly sure what that means, but our put call ratios are 21-day moving averages. So we calculate the put call ratio every day and then compute the 21-day moving average of it. There's another way you could do that, is you can sum up all the call trading over 21 days, and divide that into the sum of the put trading over 21 days. We actually also have that ratio for certain stocks, and on our website it explains which ones of those. So someone say, can you use Microsoft, for example? I didn't have the chart of Microsoft there. But if you, we are having, as I said, on Saturday, a webinar, and in that webinar we're discussing put-call ratios in depth, and we're taking questions and answers. So I would be able to get to that then if you're interested. Otherwise, I'm going to wind this up here. I'll just go back down. One more here. There's my email, and if you want to contact us, for example, I said, if you want the starting position of the New York Stock Exchange, Brent Oscillator, shoot me an email there. And if you're interested in our money management, we have a separate website for that. You can wander over there and take a look at those things as well. Okay, so I think that's going to wind it up for now, and you'll be hearing from us tomorrow with links to the PDF and recordings. Thanks for attending.